NRIs coming back to India, how to plan your stay and taxes. Hi everyone, I am Ushma Jain. Welcome back to my channel. Hope you are smiling today and everything is falling in place for you. Today, I want to talk about one of the most important questions NRIs ask me. I am planning to come back to India. How should I plan my stay and income so that I get maximum tax benefits and avoid double taxation? So if you are also confused about 182 days, 120 days, RNOR status, global income, DTAA, etc., then stay with me. By the end of this video, I am sure you will get some clarity. But before we begin, a quick disclaimer. This video is purely from the Indian tax perspective and does not cover taxation in foreign countries. The points I'll share are based on general rules, but every case is unique. Your tax liability depends on multiple factors: your country of residence, nature of income, number of days you stay in India, and even your past visits. That's why it's always best to seek professional advice before making any decisions. Now, without wasting much time, let's get started. Here are the steps we will be discussing in this video. Step 1. Why your residential status matters. Step 2. Residential status, the test as per Income Tax Act. Step 3. ROR versus RNOR. Step 4. Finance Act 2020 amendments. First, deemed residency rule. Second, 120-day rule for high-income individuals. Step 5, tax incidence based on residential status. Step 6, real-life FAQs. Step 7, practical planning. Step 8, important reminders. Step 1, why your residential status matters. Before anything else, you need to understand your residential status under Indian income tax law, because your tax liability in India completely depends on it. There are three categories for individuals: resident and ordinarily resident, which is ROR; resident but not ordinarily resident, which is RNOR; non-residents, which is NR. The category you fall into determine the portion of your income that India can tax. Step 2. Residential status, the test as per the Income Tax Act. You are a resident of India if you satisfy any of these two conditions. You stay in India for at least 182 days during the financial year, or you stay in India for at least 60 days in that financial year and at least 365 days in the 4 years before that. But wait, there are special relaxations for Indian citizens who leave India for employment, or Indian citizens or person of Indian origin coming on a visit to India. For them, the 182-day rule applies instead of 60 days. So they can stay up to 181 days in India and still maintain NRI status. Step 3. ROR versus RNOR. If you qualify as a resident, you must check whether you are a ROR or RNOR. You are ROR if you were a resident in at least 2 out of last 10 years and you stayed in India for 730 days or more in last 7 years. If you don't satisfy both these conditions, you become RNOR. RNOR is like a transition category, helpful for NRIs returning to India because foreign income is still protected to some extent. Step 4. Finance Act 2020 amendments. In 2020, new rules were introduced, very important for high-income NRIs. You can be treated as RNOR if: first, deemed residency rule. You are an Indian citizen. Your total income in India, excluding foreign income, exceeds rupees 15 lakhs. and you are not liable to tax in any other country like in UAE where there is no personal tax. In this case, even if you don't stay in India, you may still be deemed a resident but with RNOR status. Second, 120-day rule for high income individuals. You are an Indian citizen or PIO. Your Indian income exceeds rupees 50 lakhs in a year. You come to India for 120 days or more, but less than 182 days. And you also stayed for 365 days or more in past 4 years. In this case too, you will be treated as RNOR. So remember, if your Indian income crosses 15 lakhs, even 120 days can trigger residency. Step 5. Tax incidence based on residential status. Here's how taxability works. If you are ROR, your global income, which means your Indian income and foreign income, both are taxable in India. If you are RNOR, your Indian income is taxable and only two types of foreign income will be taxable, which are business income when business is controlled from India, professional income when profession is set up in India. If you are non-resident, then only Indian income will be taxable in India. This means RORs must pay tax on global income in India. RNOR get relief only limited foreign income is taxed. NR are taxed only on Indian income. Step 6. Real life FAQs. Let's look at some common scenarios. I am an Indian citizen working abroad. I came to India to take care of my parents and stayed here for more than 182 days. I worked remotely from India and my salary credited in foreign bank account. And taxes are also paid abroad. Do I pay tax in India? Answer is yes, you are resident. Depending on your past stay, you could be RNOR or ROR. I visit India every year for 3 weeks. This year also under 182 days. Income abroad, tax paid abroad. In this case, I will remain NRI, only Indian income will be taxable. I stay in India for 150 days. My income is 20 lakhs and I have been here 400 days in the last 4 years. I will become RNOR because of 120-day rule. I stay 40 days in India. My income in India is below 15 lakhs. Your residential status is an NRI then. I am a lawyer in USA. Also have a firm in India. Stay more than 120 days and Indian income is more than 18 lakhs. You will be RNOR. Both your Indian income and Indian linked foreign income will be taxable in here. You see how just the number of days plus income level can change everything. Step 7. Practical planning. If you are just visiting India, try to keep your stay below 182 days to maintain NRI status. If you are returning permanently, try to plan so that you qualify as RNOR for 2 to 3 years. This protects your foreign income temporarily. Once you become ROR, all your global income is taxable in India and you will need to report it in your ITR. How to report it? I have made a detailed video on this, but just to give you a crux, you have to convert your foreign income in INR using the specified forex rules, claim relief through DTAA by filing Form 67, stay compliant with disclosure requirements. Step 8. Important reminders. Here I want to mention few important points. DTAA doesn't mean no tax. It's only ensure you don't pay tax twice. You can't avoid tax in both countries. Tax planning needs to be done in advance. Sometimes even a few days stay can make a big difference. Professional guidance is strongly recommended, especially during transition years. So if you are planning your move to India, remember, track your days carefully, understand your residential status, plan for RNOR where possible, and comply with DTAA and reporting rules. This will save you from unnecessary stress and unexpected tax bills. I hope you found this information useful. That's it for today's video. Thanks for being here with me. Stay safe, stay cheerful, and I'll see you next time. Bye.